You open a brokerage account for the first time. The screen is staring back at you with ticker symbols, charts, green and red percentages, and a search bar that might as well say, "Type your confusion here." You have some money sitting in your checking account doing absolutely nothing. And you know you're supposed to invest it. But every time you try to figure out where to start, you end up in a 47-tab rabbit hole that somehow ends with you watching a guy on YouTube argue about whether Bitcoin is going to $500,000 or zero. So you close the laptop. Tell yourself you'll figure it out next month. And next month becomes next year. Here's the thing nobody tells you. The confusion is not an accident. The financial industry makes a lot more money when you're overwhelmed. When you're paralyzed. When you hand your money to someone who charges you 1% annually to do something you could do yourself in about 20 minutes a month. The complexity is the product. And the moment you see through it, investing becomes almost embarrassingly simple. My name is Nick, and I spend way too much time thinking about money, investing, and why the gap between people who build wealth and people who don't has almost nothing to do with intelligence or income. If you want to stop overthinking this and actually understand what to do with your money in 2026, make sure to hit that subscribe button and give this video a thumbs up if it ends up cutting through the noise for you. Now, before I walk you through exactly what I would do if I were starting from scratch today, let me ask you something. When you think about investing, what's the first feeling that shows up? For most people, it's not excitement. It's dread. A vague sense that you're already behind, that everyone else figured this out years ago, and that the market is basically a casino where the house always wins unless you're already rich. And I get it. Because if your only exposure to investing is CNBC, Reddit forums, and your uncle who swears he made a fortune on options, then of course it feels like gambling. But here's where most people get it completely wrong. Investing isn't about finding the hot stock before everyone else does. It's not about timing the market or predicting the next crash or knowing which sector is going to explode in the next 6 months. Real investing, the kind that actually builds wealth for ordinary people, is almost aggressively boring. And boring is exactly what you want it to be. So let's start at the very beginning. Because if I were sitting down with zero investing experience in 2026, the first thing I would do isn't open a brokerage account. It isn't research stocks. It isn't even think about the market. The first thing I would do is deal with my financial foundation. And most people skip this step entirely. Which is exactly why most people never actually build wealth. Here's what I mean. Investing while you have high-interest debt is like trying to fill a bathtub with the drain open. You can keep pouring water in, and technically water is going in, but you're losing faster than you're gaining. The average credit card interest rate right now is sitting somewhere above 20%. Meanwhile, the stock market has historically returned around 10% annually over the long run. Do the math. If you're paying 22% interest on debt while earning 10% on investments, you're losing 12% every single year on that decision. Paying off high-interest debt isn't the boring, responsible alternative to investing. It is investing. It's a guaranteed 22% return, which is something no stock on earth can promise you. So step 1 is simple and brutal. Before you touch the market, kill the high-interest debt. Credit cards, personal loans, anything above roughly 7 or 8%. Gone. First. Non-negotiable. This is the unsexy move that sets up everything else. Now, once the high-interest debt is handled, here's where most financial advice gets it wrong again. They tell you to start investing immediately. Max out your accounts. Put everything in the market. And while the intention is right, they're skipping something critical. Because if you start investing before you have an emergency fund, you've created a trap for yourself. One that millions of people fall into every single year. Think about what actually happens when you're fully invested with no cash cushion and your car breaks down, or your company does layoffs, or some medical bill shows up that you weren't planning for. You don't have options. You either go into debt, which destroys the progress you were making, or you sell your investments at whatever price the market happens to be at that day, which may or may not be a terrible time to sell. You become a forced seller. And forced sellers almost always get punished. The emergency fund isn't a consolation prize for people who can't figure out investing. It's the thing that keeps your investment strategy intact when life does what life always does. 3 to 6 months of living expenses. Sitting somewhere boring and accessible. A high-yield savings account, a money market fund, short-term treasuries. Something that earns you something while staying liquid. That buffer is what lets your investments actually compound instead of getting raided every time reality shows up uninvited. But here's where it gets really interesting. And this is the part that changes how you think about investing forever. Once the debt is gone and the emergency fund is built, most people make a second massive mistake. They think the most important decision they're about to make is which stocks to pick. They spend weeks reading earnings reports and analyst ratings and Reddit threads. They agonize over whether to buy Apple or Microsoft or some small-cap biotech that a stranger on the internet is very confident about. And the entire time, they're optimizing the wrong thing. The single most important investing decision you will ever make is not what to buy. It's where to put it. Because the account type you use determines how much of your returns you actually keep. And the difference between getting this right and getting it wrong is worth hundreds of thousands of dollars over a lifetime. Not because of the investments themselves, but because of taxes. Let me show you exactly what I mean. Two people invest $500 a month for 30 years, both earning the same 8% annual return. Person A invests in a regular taxable brokerage account. Person B uses a Roth IRA. After 30 years, they've both built roughly $680,000 in their accounts. Same money, same return, same timeline. But when Person A starts withdrawing, the IRS takes their cut on every dollar of growth. Depending on their tax situation, they might walk away with $500,000 or less. Person B withdraws the entire $680,000 tax-free. Every single dollar. Because they got the account type right. That one decision, made at the beginning, is worth potentially $180,000 without doing anything differently with the actual investments. So if I were starting today, here's the exact order I would follow. First, if your employer offers a 401k with a match, you contribute at least enough to get the full match. Immediately. Every dollar of match your employer offers is a 50 to 100% instant return on your money before the market does anything. Leaving that on the table is one of the most expensive mistakes in personal finance. Second, I'd open a Roth IRA and start maxing it out. In 2026, the contribution limit is $7,000 per year if you're under 50. That's $583 a month. The Roth is the most powerful wealth-building account most regular people have access to. Tax-free growth, tax-free withdrawals in retirement, and no required minimum distributions forcing you to take money out before you're ready. If you're early in your career and you expect your income to grow over time, the Roth is almost always the right move because you're paying taxes now, at your lower rate, instead of later when you're hopefully in a higher bracket. Third, if there's still money left after the Roth, go back and fill up the 401k. Then, a taxable brokerage for anything beyond that. That sequence. 401k to match, Roth IRA, rest of 401k, then taxable. That's not complicated. That's the framework. And it works regardless of what the market is doing, what the Fed is doing, or what any pundit on financial television is screaming about. Now let's talk about what to actually put inside these accounts. Because this is where people get into real trouble. When most people first start investing, they think they need to pick stocks. Individual companies. The right ones. And I understand the appeal. There's something exciting about owning a piece of a specific business. Something that feels smart about analyzing a company and deciding it's undervalued. The problem is, the data on this is absolutely brutal. Study after study, decade after decade, shows that the overwhelming majority of professional fund managers, people who do this full-time with teams of analysts and decades of experience, fail to consistently beat a simple index fund over long-time horizons. We're talking about 80 to 90% of active fund managers underperforming the index over 15-year periods. Not because they're bad at their jobs, but because markets are incredibly efficient and competition is vicious. And if the professionals can't reliably do it, what makes any of us think we can do better with a few hours of YouTube research? Here's what I would actually own if I were starting in 2026. 2 funds. That's it. Maybe 3. A total U.S. market index fund. Something like VTI or FSKAX. This gives you ownership in essentially every publicly traded company in America. Thousands of companies. From massive multinationals down to small emerging businesses. 1 fund, instant diversification across the entire U.S. economy. When the economy grows, you grow. When individual companies fail, which they always do eventually, it barely registers because you own everything. Second, a total international index fund. Something like VXUS. This gives you exposure to developed and emerging markets outside the US, Europe, Asia, Latin America. Because the US stock market is not the world economy, and putting everything in one country, even a great one, is a concentration risk you don't need to take. Some people argue the US is so dominant that international exposure is unnecessary. Maybe. But I'd rather own a slice of the global economy than bet everything on one country continuing its historical dominance forever. That's the portfolio. VTI and VXUS. Maybe 70/30ths or 80/20ths US to international depending on your comfort level. Set it up. Automate the contributions. And then do the hardest thing in investing, which is almost nothing. But here's where the story gets even more interesting. And honestly, this might be the most important thing I say in this entire video. Picking the right funds is actually the easy part. I know that sounds backwards. But bear with me. Because the real enemy of building wealth through investing isn't picking the wrong stock. It isn't a market crash. It isn't inflation or interest rates or geopolitical risk or any of the things that dominate financial headlines. The real enemy is you. Specifically, your brain's completely predictable, completely understandable, and completely destructive response to market volatility. Here's what's going to happen if you start investing today. At some point, probably multiple times over your investing lifetime, the market is going to drop. Maybe 10%. Maybe 30%. Maybe, if you're particularly unlucky with timing, 50%. And when it does, here's what your brain is going to tell you. It's different this time. This isn't just a normal correction. This is the one where it doesn't come back. You need to get out before it gets worse. Sell now and buy back in when it's safe again. This voice is the single most expensive voice in the history of personal finance. The data on this is almost comical in how consistent it is. J.P. Morgan runs an analysis every year looking at what happens to investors who miss just the best trading days in the market. If you were fully invested in the S&P 500 from 2002 to 2021 and held through everything, you averaged about 9.5% annually. If you missed just the 10 best days in that entire 20-year period, because you were trying to time the market and happened to be in cash on those days, your return drops to 5.3%. Miss the 20 best days, you're down to 2%. Miss the 40 best days, you've actually lost money over 2 decades while the market nearly tripled. And here's the brutal reality of market timing. The best days almost always happen right in the middle of the worst periods. During crashes. When everything feels most terrifying. When your brain is most convincingly telling you that you should have gotten out already. The person who stays invested through the crash gets the recovery. The person who sold to protect themselves misses it entirely. This is why I say the portfolio is the easy part. Choosing VTI and VXUS takes about 15 minutes of research. Holding them through a 35% drawdown while your neighbor is texting you that he sold everything and you should too, that takes something different entirely. So if I were starting in 2026, here's what I would actually do to protect myself from myself. First, I would automate everything. Automatic contributions on payday, before I could see the money and decide I needed it for something else. Automation removes the decision from the equation and removes the temptation to second guess. Second, I would decide in advance what my response to a crash would be. Write it down if necessary. When the market drops 20%, I will buy more. Not sell. Not pause contributions. Buy more. Because a 20% drop means everything I was going to buy next month just went on sale. Third, I would stop looking at my portfolio every day. Checking your account balance daily when you're a long-term investor is like weighing yourself 10 times a day while on a diet. The short-term noise is meaningless and the obsession makes you more likely to make bad decisions, not better ones. Now let's talk about something that most beginner investing content completely avoids because it sounds like it kills the excitement. Fees. I know. Riveting. But here's why you need to care about this. When you buy an index fund, the fund charges a small annual fee called an expense ratio. This is taken automatically from your returns and expressed as a percentage of your investment. The expense ratio on a Vanguard or Fidelity Total Market Index fund is somewhere around 0.03 to 0.04%. That's 3 to 4 cents for every $100 you have invested annually. Essentially free. Now compare that to the average actively managed mutual fund, which charges around 0.5 to 1% per year. And some of the funds sold through brokers or advisors who work on commission charge even more. Some go above 1.5%. Here's what that difference actually costs you in real money. Invest $100,000 at 8% growth over 30 years with a 0.04% expense ratio. You end up with roughly $993,000. Same scenario with a 1% expense ratio. You end up with about $761,000. The fee didn't reduce your return by 1%. It reduced your final balance by $232,000. Because fees compound the same way returns do, just in the wrong direction. This is one of those things that feels like a small detail but operates like a massive hidden tax on your wealth. The fund manager charging you 1% isn't delivering better performance to justify it. They're almost certainly delivering worse performance because of it. The research on this is overwhelming and has been for decades. Low-cost index funds win. Not sometimes. Consistently. Over long time horizons. Against the best-paid analysts on Wall Street. Pick the cheap fund. It is almost always the right choice. Now, here's what most people completely miss when they think about investing. And this might make you question everything you've been told about what it means to be a good investor. The best thing that can happen to you as a young investor isn't the market going up. It's the market going down while you're still accumulating. I know that sounds insane. So let me show you exactly why it's true. Imagine you're putting $1,000 a month into an index fund for the next 20 years. In scenario A, the market goes straight up. 10% every year, smooth and steady. You feel great. You watch your balance grow. Life is good. In scenario B, the market crashes 40% in year 3 and takes 5 years to fully recover. You feel terrible during that period. The news is awful. Your balance looks awful. But here's what's actually happening. Every month during that crash and recovery, you're buying more shares at lower prices. You're buying the same amount of the market for less money. And when the market eventually recovers, and historically it always has, all those cheap shares are now worth full price again. Scenario B investors, the ones who held through the crash and kept buying, often end up significantly ahead of Scenario A investors because of those years of buying at a discount. This is why young investors should genuinely want volatility. A crash in your 20s or 30s, when you're decades away from needing the money and actively contributing every month, is not a disaster. It's a gift. The disaster version is a crash in your 60s when you're withdrawing, which is a completely different problem for a completely different stage of the journey. Understanding this reframes everything about how you watch the market. A red day isn't a loss. It's a sale. And when you're a long-term buyer, sales are good. But here's the part that will probably make you laugh, and maybe feel a little cheated at the same time. After everything we just covered, the account types, the fund selection, the automation, the psychology, the fee optimization. After all of that, the single biggest predictor of how much wealth you build isn't your investment returns. It's not your fund choices. It's not whether you picked VTI or VOO or FSKAX. It's your savings rate. How much of your income you actually invest, consistently, over time. That number dwarfs everything else. A person who invests 25% of a $60,000 salary in index funds will almost always build more wealth than a person who invests 5% of a $120,000 salary in brilliantly selected individual stocks. Because the biggest input to the wealth equation isn't return rate. It's the amount going in. This means the most productive thing most people can do to improve their investing outcomes has nothing to do with the market at all. It's increasing income, reducing expenses, widening the gap between what comes in and what goes out, and protecting that gap by making the investment contribution automatic before the money has a chance to become something else. That's the game. And it's not a complicated game. It's just a patient one. Here's what I want you to take away from this. Starting to invest in 2026 is not harder than it has ever been. In some ways it's easier. You have access to zero-commission brokerages, fractional shares that let you invest with almost any amount, and index funds so cheap they're essentially free. The tools available to a 22-year-old today are better than what the wealthiest investors in the world had access to 30 years ago. The information advantage that used to belong exclusively to Wall Street is now sitting in your pocket. What hasn't changed is the human side. The patience required to stay invested when everything in your brain is screaming to sell. The discipline to keep contributing when the market looks terrifying. The ability to ignore a financial media ecosystem that is economically incentivized to make you feel like you're always about to miss something or always about to lose everything. The people who build real wealth through investing aren't smarter than you. They're not better at predicting the market. They're not plugged into some exclusive information network. They're just consistent. They made a simple plan. They automated it. They stopped looking for a better plan every 6 months. And they let time do what time does. Your future self doesn't need you to find the next great stock. They need you to start. To pick a boring fund. To automate the contribution. To not touch it when it gets scary. And to do that, not once, not for a year, but for as long as it takes. That future version of you, the one who figured this out, is counting on the decision you make right now. Don't make them wait any longer.